Manhattan's a great example. You can give me a quarter acre and I can put hundreds of units on it. You give me a quarter acre in the area I live, I can't even put one cow on it.
What do you consider a good return?
We see companies out there that are offering 30% return. The higher the returns, the greater your risk is.
Have you had any nightmare stories about the infrastructure piece?
So we got everything approved and we start digging a foundation and we found a buried gas station.
We heard of a developer who was developing a site. He wasn't aware of it, but in the 20s it was an orchard. It was more rural, so it required well, and all the water was contaminated with arsenic, and didn't find out until...
I love your podcast. It's a lot of fun. I watched one and I'm like, I don't know if I'm going to be any good guest. I'm not nearly as funny as most of your guests.
I think you made it up with the amount of education you're providing.
The tax code is written that they want us to build and create communities.
I'm just trying to understand how much will I get back.
If you did $100,000 investment, we're projecting that at the end of 2 years, you would have $131,000.
What is your advice for someone who's trying to start out as a developer?
And they don't have capital reserves?
We ended up working with this bank. We didn't put any money into the deal, and we worked with several hundred assets to help work through, and we made a lot of money off of it.
How do you plan for market risk, say another
recession?
2000?
I can remember you brought a deal on an apartment complex, and they brought me this feasibility study. And so I go right to the executive summary, and I skim through it, and the last paragraph is, this is a great deal, you should do it, and it gave all the reasons why. I have no idea how they came up with a conclusion. You have to be really careful to make sure that...
In today's episode, we're talking to Dale, a real estate development expert who builds thriving communities in the Midwest United States.
We'll cover what it takes to be a developer and how to raise capital using private equity funds.
Stick till the end to learn the top tips for entrepreneurs starting in real estate and what kind of returns you can expect in today's market. Dale, what mission are you on?
I think about some of my most formidable memories are being a child, and the memories of learning how to ride my bike, playing with Tonka trucks in the backyard, eating dinner at the table. And I just love creating memories. And so effectively we as a company, we create communities for people to have those memories created.
When you talk about creating communities, you're essentially buying vacant land, and then procuring permits and doing constructions, that kind of thing?
In essence, yeah, we are developing land and creating, the communities that we live in.
I see. Erica, you want to talk about your business model and get his thoughts on it? I mean, we're pretty small scale, but...
Yeah, we're not quite at your scale. I do have a land company. I'm a land investor, so I buy basic flipping. I buy and sell land. So we send direct mail to owners, just letting them know we're interested, and we purchase from the owners and then we list them. Do you do something similar, or you already have?
We don't do much of that. We love you. So we really focus on building relationships and having partnerships with you. So we love what you do, and we love building strategic relationships because it's just so critical, and that's a unique ability, I think, of what you do.
So what percentage of your deal flow is coming through like traditional brokers as opposed to you finding them directly?
I would say we probably find 20% of our deals are direct. And then I would say 40% are probably through real estate brokers, similar to what you're talking about. And then the other 40% come either direct from cities that own land, or real estate attorneys, consultants that work through the cities. We really love working with cities that own land because it really becomes a cooperative effort, and we can really create something pretty cool. And we've got a few examples that we've done of that and really have loved it.
When you work with the city is selling you land, do they often, because I actually used to work for the New York City Affordable Housing Agency. So are these projects that are tied to specific city goals like affordable housing or senior housing, something like that?
Yes. So one example that I gave earlier on the school site, that was city owned. So the school district built a new school. They left this site, and then they wanted to sell it. But the building had asbestos, it had some contaminated soils, different challenges with it. So when the school put it on the market, the city quickly went in and bought it. And they wanted to be able to create a vision. It was an area that was pretty strategic of what they were trying to accomplish. And so they said, if we can control the site, that's how, we're going to get our vision. And we had done another project in the neighboring city, and the city's consultant that had helped them through that reached out and said, is this something you guys would be willing to do a proposal on? And we said, yeah, absolutely. We would love to. So we met with the city, said, hey, what is your vision? What are you trying to accomplish? What's your goals? And they mapped it out. And, I love to use the example. I remember telling the city, I said, I can do anything you want. Tell me what you want. I can build a $5 million house in the middle of the property and sell it if that's what you want. You just need to understand you'll have to give me the land for free and write a check for probably about $4.5 million. That always enlists a good laugh. But the reality is we really can. If they own it, we can do anything they want.
So, Erica, when you worked in New York City, would you reach out to potential developers, or is it like an RFP process?
RFP. It all had to be through a competitive bidding process. Yeah.
Is that the similar scenario in Minnesota?
It is. Yeah, they'll do an RFP. So request for a proposal, and we'll go in. One thing that I find will be unique is we'll go in and ask more questions. It's so often there's something missing in that RFP of, what an elected official or on a planning commission, somebody that has an interest that didn't get in there. So we'll usually try to do a little bit of homework before we propose to find out what are those unique things that really are driving this project. And then we'll put the RFP in. But I think that's pretty common in most states. There's some level of a requirement that you can't just go do a side deal real quick.
Yeah. I think that's pretty standard these days across government.
And it makes sense, protect our money and the investments.
Oh, it has to be a competitive process.
So if you have like 3 or like 5 contractors or contracting companies that submit the bid, it's written in like it's a policy that you have to take the lowest bid?
It depends on the agency and the project, but often that can be the case. Yeah.
Well, who makes that decision?
Some of it is based on the laws as they're written and what the agency has the power to do. But sometimes it's just written into the RFP. But cost always has to be a factor, regardless.
So Dale, do you also see the same thing where you have to outbid your competitors? Like, is cost the only way you can outbid them, or can you add values in other ways as well?
That's a really great question. I don't think the Minnesota market's quite as strict as what Erica was just explaining, in that they can, if there's mitigating factors, they can go with somebody that's not the most cost advantageous. So if we're providing a product that is unique to what they're wanting, then they can make the decision. They've got to be able to justify that decision. They don't want it to be just, well, we really like him, he's a friendly guy, but they've got to justify it. And so there is a little more flexibility in our market for the municipalities to make a decision outside of just economics.
I see. I was also curious to know about like how you acquire funding for a project this size. Is that also depend on like your existing relationships with lenders?
That's an interesting question. We historically we've had a single equity partner when we need equity that we'll go to, and he's been a really great partner for many years, and we'll do the deals with him. And then we usually will use the debt through a local or a regional bank. But last week we launched a private equity fund, and so we've started a fund to be able to let other people be part of, doing these communities and getting a good return. And so we started Centric Capital Partners with that intent to be able to do more of that.
Right.
Oh, congratulations.
Yeah, congrats.
But
I would love to understand the mechanics of how to launch a private equity fund, unless you want to take it into another direction.
I'm sorry, I'm going to go off on a tangent here, but it's interesting to me because actually the program I was working with in New York City was the one for sale program. in the affordable housing world that we have. And it was really challenging because there aren't a lot of these same traditional public funding sources for sale housing that you get in the rental world. So in Minnesota, it sounds like that's the case here. So is it that the cities are primarily interested in getting the sites back on the tax roll, so they're okay with market rate housing?
Minnesota's interesting. It's really is unfortunate. A lot of cities are afraid of affordable housing. People like to use other terms, and I can remember I went to an open house. Somebody was building workforce housing, so another name for affordable housing, and it was an apartment complex, and it was beautiful. The design was gorgeous, and it was going to really fit a need. And they had to postpone this hearing because the city council chambers were packed. It was standing room only, and people couldn't get in. So they rescheduled it to be in an auditorium of a high school. And again, this is packed, standing room only. Hundreds and hundreds of people are here. And one person after another stand up and say, I don't want that in my backyard. I don't want those poor people. I don't want those horrible people. And it was really just heartbreaking. You're watching this. It was amazing. A lady stands up and she goes, it was just so perfect. She looks around the room and she goes, you're a sheriff's deputy. You qualify to live in this housing. And you're a school teacher. You qualify. And she names 5 or 6 people in the room, names them by name, what they do for a living, and says, you are those people that you are all wanting out of our city. And we live here. And she sits down and I'm just like, hallelujah, this is going to change the trajectory. And the very next person gets up, we don't want those people in our city. And I was just like, this is unbelievable to me. And it ended up passing. They ended up putting it in, and it is a stunning complex that this team built. It looks beautiful, and you'd have no idea that it's affordable in that, it's designed to be able to put our school teachers and our sheriff deputies and the people that we really need in our communities living there. It's a really strange dynamic that so many communities within Minnesota are opposed to just the basic housing needs that we have.
Yeah, the word affordable is
it's become a bit.
No, actually, no. I was gonna say the other way. I was thinking of this friend who was like, he's an IT consultant. He makes like $110K per year, and he applied for affordable housing and he got it. And I was like, how is that even possible? He's making $110K.
To be fair, that was a really unique project where they did have higher income requirements than is typical in a affordable housing project. They were.
And it's all relative. 110K is a little bit different in some, in Manhattan, 110K means something very different than what it does in Rochester, New York.
Yeah.
Right. Can I go back to private equity now?
Okay.
So I'm just curious to know, is this your first private equity fund, or do you have experience in it?
Nope, this is our first. We know we're really good at real estate. We're really good at building. We're really good at developing, and we know our stuff. And we've made really good returns. It actually started about 1.5 years, 2 years ago. I'm looking at it going, our tax code is written for us to invest in the areas that Congress wants us to. And the tax code is written that they want us to build and develop and create communities because there's so many benefits when it comes to real estate on the tax code. Well, as a result, if you're in the industry, you reap a lot of those benefits. And so you get lots of tax deductions and benefits to that. And I'm looking at this going, I've got some really amazing team members. And what I would love to do is, how do I help them create a retirement? And, it's not fair. They don't get the same benefits I do, although we do the same thing, but because I'm the owner. And that's where it really started. How do I help them create wealth? How do I help them create a retirement? And so I started digging and looking and trying to figure that out. And it evolved into, wait a minute, I could do this theory, but bring it effectively to the masses. And so anybody that wants to be part of building communities, get a good return. And so that's ultimately how it all came about is trying to help our team members to create wealth. We said, well, not only could we create something that helps them our team members create wealth, we could do it with anybody that wants to invest. And so that's where the whole idea started and was created from. And so we've done a ton of work. There's a lot of legal work to make sure that the investors are protected. So we've got a lot of legal work we had to create. And then, your basic marketing, creating a website, all the marketing that goes into, a funnel to funnel the potential investors. And then the memorandum, the private placement memorandum is what they call it, which describes what the investment is. So what are the rules of the game? What is the returns we're going to give you? If things don't go well, what happens when things go well? What's the upside? And so it describes all of that. And then the other things we do is we've always done. Now we're just making it more public. So we're doing the forecasting of, what's it going to cost to develop the project? What's it going to cost to build the homes? What is the demand? What's the product type that people need here? And so we create, we now use that to be able to, an investor can look at that. They can see what those forecasts are. They can see how we're projecting what the return should be. And so we formalized that more to make it more palatable. So, we have lots of spreadsheets that we've used that if you don't quite understand them, they can be quite confusing. So we had to take those and say, all right, how do we make them, for somebody that's not a real estate expert to be able to follow that naturally and understand it.
Right. No.
So there was a lot of effort to get to this point, and so
right.
So now we're at the finish line, hoping it works.
Let's dig deep one by one, break it together or break it apart. So when you say community, can you define what that means? Does that mean we're looking at like 200 plus homes, like subdivision, or are we talking about 10 plus homes? So can you define community? So
when we're looking at housing as a company, we generally don't do much of anything under 25 homes. Your effort to develop 200 homes versus developing 20 homes, as far as getting the approvals and the entitlements completed, it's the same amount of effort. And so we will typically not look at anything much less than 25 homes. And, our initial offerings, we've got an offering right now that we just opened up that's a 39 lots. The entire subdivision was, 48 plus 39 was the total. So our first phase was the 48, and we're on the tail end of that. And so we said, this second phase would be a good one because it's a proven project. And so it'd be just 39 homes. Another one that we're going to be offering up is 105. So generally, if we're doing an equity raise, it's typically going to be something that we're raising $2 million or more for. In that, if it's a smaller deal, we would likely just do it ourselves. Because there's a lot of effort to get to this point to raise the capital. And so if we're doing something that's 25 lots, we would likely just do it internally because of all the paperwork and setup that goes into it.
I see.
At what point in the project cycle or in the permitting process, should I say, do you start soliciting equity funding? Do that after permitting or prior?
That's something that we've internally had a lot of discussions. Do we want to go raise capital for a project that we're not absolutely positive is going to go because we don't have all the approvals? But at the same time, if you wait for all of the approvals, you better be able to move quickly on raising the capital. So in our case right now, we are raising capital only on deals that we're 100% approved on by the city. So example, the 39 lots, we already own the land. It's already approved by the city. We actually already have equipment sitting on site ready to start putting the sewer in. And so we're going to raise the capital, and then we need to, Minnesota, the frost is so deep in the ground, you have to wait until most of that frost gets out. Otherwise, it's very expensive to develop. So in this case, we are well down the road, and that's the first 4 deals that we have will all be like that. And so there's pros and cons to both sides, and I'm not sure we know for sure what the right answer is yet.
But theoretically, if you're not able to raise capital through the private equity offering, you could always go to a bank and raise traditional conventional loan or something, right?
Yeah, so these first 4 deals. So this first deal, as an example, we will go get bank debt. And so we'll get equity, we'll raise equity. In this particular one, we'll raise $2 million, and that'll be the equity. And then the balance of it, which would be 65% of the need, we would go get from a local bank that we work with. And the reason we do that is an example on this deal, we're projecting based on the first phase a 17.8% IRR. And I can go borrow bank debt at 7%. But if we go raise equity for 100% of that amount that we need, then what happens is that IRR drops quite a bit. Because if I can go borrow at 8%, that just means that I have more left to share with you. And that's what drives our return to the investors at 17.8%.
Because you're paying less to the bank?
That's correct. Yep. Because the banks right now, we're borrowing from the banks at 7%. And so if I can borrow at 7%, that just means that I can give a better return to the investors. And so that's why we've decided to do the leveraging with the banks, is just to be able to give a better return.
I see. And what do you consider a good return?
You see all over the market, as we did our due diligence on this, what do we need to do? We see companies out there that are offering, 20%, 30% returns. And quite frankly, I look at them and go, that seems a little bit too good to be true. If somebody's offering you a 25% return, there's got to be a lot of risk involved. And that's the reality of any investment. The higher the returns, the greater your risk is. And so when I see these real estate deals that are offering the 20s and 30% returns, those are fantastic, amazing returns. And, the risk is coming with it. What we're seeing in the market is, if you're in real estate, if you can be an 8% to a 20% return is pretty competitive, is what we're seeing. You're going to be on that lower end if it's a stabilized product. It's maybe an apartment complex that's already occupied, so your risk is pretty low. When you get into development, you're creating more risk, and therefore that's where the returns get a little bit higher. And so, your risk is also looking at, what's the experience of the sponsor meaning the person that's doing the work. So if somebody's never done a deal before and offering a 25% return, well, that's why, because they've never done a deal before. And there's clearly a big risk if they don't have any experience. And so, that's where we see experienced sponsors are generally, on a development deal, 14 to 18%. And we're on that higher end on our first deal. But we're pretty comfortable with that.
Right. So this 14%, when does the actual payout begin?
So for us, the payout begins when we start selling houses. So it depends on the project. If you're buying an existing apartment complex that's got income producing, you're getting returns immediately. And that would be another reason why you might be looking at an 8 to 12% return, because you're getting return. So if somebody, they're using that investment as part of their livelihood, then they're going to want a return that's immediate. They're going to want to invest in real estate that's already cash flowing. Whereas in our case, we'll go in, we'll start developing in the next 60 days or so. We'll put the streets in, then we'll start building houses. Well, by the time we put the development in, we build the houses, you're about 6-8 months before we're bringing in cash because we've sold houses. And at that point, that's when the investors start getting their return, is when the houses start closing.
Right.
It only takes you 6 months to get the bulk of the infrastructure up. That's very fast.
Yeah, it depends on the project. This particular one, we already own it, and the mass grading is already done. So we've already, the road's already cut. So all we have left is to put the sewer infrastructure, the sewer, the water, utilities, the asphalt, and the sidewalks. That'll take us 6 to 8 weeks to put in, and then we'll start building houses almost immediately. And right now, our houses take about 4 months to build.
That's fast, no?
Yeah, that's it. Well, I'm just comparing it to New York City, which is like a nightmare to.
But I think it's
build
fast because they already have the entitlements in place, right?
Well, yes, but even if you're just looking at time frame from end of entitling to, development of the infrastructure.
Wait, you're developing them. Do you have partners in place that do the construction, or is that also in-house for you?
We do. So we actually don't physically do any construction, but we supervise it all out. So we will hire an excavation company that'll go in and put all the utilities in. We will hire a company that'll put all the curb and sidewalk, a company that'll put the asphalt, and the same thing with the houses. So we have an entire purchasing team that they will find and qualify each of the contractors. So they'll find plumbers and framers and roofers, qualify them, make sure they understand what they're bidding, get the best bids, and then contract with them. And then we manage that entire process of each of those contractors that come in as they go. For us, that isn't really involved because we've been doing this for so many years. We generally end up using the same contractors over and over, the ones that we have a relationship with.
I see.
Have you had any, I guess you could say, nightmare stories about the infrastructure piece? Because, I mean, I think back on developing in New York City, and like every other project, something would come up, contaminated rock or...
Yeah, we have a few stories.
You talked about
lines.
risks. Yeah, what are the risks? Yeah, give us examples.
We've had a few. We had one. It was an infill redevelopment piece. The city owned it, and we go in and you're familiar with this, Erica, but for our listeners, we do what's called a phase 1 and a phase 2 environmental study. And so we go in and we identify what are all the potential risks. So phase 1 is they're looking at what's the history of the property, what could be here, what could have happened. And phase 1 will trigger of, oh, hey, there's this, we need to look into it a little bit deeper. And so then they'll do a phase 2. And unfortunately, not always do they discover everything in these environmental studies. So we had this piece, they did a phase 1 and they said, well, there's some history on this site that goes back to the 1920s, 1930s. Let's research it more. So then they did the phase 2, and the phase 2 can consist of taking soil samples, digging test pits, air quality, checking on different plant species. Lots can go into these. And the phase 2 came back and said, yeah, you're okay. So we got everything approved and we go to dig and we start digging a foundation. And it just so happened phase 2 didn't dig in the right spots, and we found a buried gas station that was from the 1920s and 1930s. And so that was a little bit of a surprise for us. And luckily, we were able to remediate it fairly quickly, and it wasn't too costly. But yeah, we've had a few examples where there's just surprises. And, you want to do your due diligence. You want to do everything you can to protect yourself. And then just sometimes there's surprises that no matter how good you are and how much you're reviewing, that sometimes you get caught.
Yeah, there's only so many borings you can take. I mean, I know we had one project where they even took extra, but somehow still 2/3 of the lot was taken up by contaminated rock, and just none of those borings hit the right place.
How was the rock contaminated?
Well, there was a groundwater flow, and the water was contaminated because it's New York City. So, it could be from anything, but there's a lot of old industrial sites.
And you can't just remove the rock, right? Because it's a rock.
Well, first you do need to remove it, but first you need to remove it in a safe manner. So you have to remediate it first.
Right. And it's expensive.
That was very expensive. It almost killed the project.
So in your case, yeah, go ahead.
We have an example like that we just went through, and we walked away from the deal. It's a golf course, and it wasn't performing anymore, and so they wanted to sell it. So we put it under contract to buy it, and in the process, we knew golf courses, there's a risk of higher mercury in the soil. And so we did the phase 1 and phase 2. Back in the 1970s, the greens, to green them up, they would put a product that had mercury in them as part of the fertilizer. Well, as we know now, mercury is not a really healthy thing for us. And so we would do soil boring. So they would dig into the soil, pull some soil samples, and then they would test it. And sure enough, we found there was mercury. So, okay, we now know there's mercury. They were using this, but now we know how widespread. Well, in the 70s, when they were using this, generally they just did it on the greens. And so those, relative to an entire golf course, that's a fairly small space. We said, well, let's make sure. So we did soil borings in the fairways and other places. Well, we found that there was mercury contamination much wider across this project than just the greens. And so we then looked at it and said, what do we have to do? Well, ultimately, what we had to do is any of the soils that had mercury over a certain level, we'd have to dig those soils out. We'd have to put them in trucks. They would haul them to Wisconsin. It was about 2 hours away. They would put the soils in a process and they would basically cook the soil so hot that the mercury would burn off. And then the soil would be good, and then you'd bring it back. And so you can imagine if you have a whole golf course that this is all over the place, the cost, because the mercury in most places was about a foot deep. And ultimately, the cost to do that was more than what the land was worth. And so the only way that golf course will likely ever be developed is if there's some type of a government subsidy, because it's just, you give me the land for free and we just can't make it work because it's so expensive to clean that soil up. And so that's what you will commonly see sometimes. And there are government programs. Federal government has what they call a brownfield program that you can lean on, but that's probably what will happen to that golf course. And, similar to what Erica was talking about, just, it can be really expensive.
That reminds me of one story we heard of a developer who was developing a site. He wasn't aware of it initially, but in the 20s, it was an orchard. And on the East Coast, in the 20s, arsenic was a common pesticide used in orchards. So the water, and this was going to be a development, it was more rural, so it required well water. And all the groundwater was contaminated with arsenic.
Oof.
And didn't find out until
fairways. The residents got sick, right?
Yeah.
So it was after the fact is when it was discovered?
Yeah, that was, I'm not sure.
But it was in the 20s, right? 1920s?
Yeah, they were not aware that it was an orchard, although I'm not sure how that was possible, because theoretically the phase 1 should have caught it and they should have tested the well water.
Maybe there was no requirement back in the day to do phase 1, right?
Yeah, I mean, this was a while ago, so.
Yeah, phase 1s aren't perfect. We found a gas station.
So I want you to go back to the financials, right, and the timelines. So you mentioned 17% IRR, right? So can you explain that in layman terms? So, for example, if I were to invest $100,000, am I looking at $17,000 returned every year that $100,000 is invested? Is that how it works?
So that's a really good question, and the answer is no. An IRR is your internal rate of return. And so you can have your return on investment. Some people talk about that. And so if you have a 2-year investment, it's 100,000, you get 17,000. Well, that's half of 17 because it took 2 years if you're looking at interest. But your return on investment is what's your overall return. Your interest rate return would then be 17.8, as you're getting that 17.8 regularly. An IRR is a calculation of, we chose to go IRR only because that's what the industry standard is. So if you look at this project, the return on investment, we're forecasting this to be 2 years from start to finish. The return on investment is about 31.5. Well, if you do the math, if you cut that in half, that's not 17.8. It's less than 17.8. And so your return on investment is, I think it was 31.5, your IRR 17.8. Well, your IRR is a mechanism. How much is it invested? So when we get to the point that we're now selling houses and we're producing cash, well, every time we sell a house, we're now producing some of that equity is coming back. And so when we start selling houses, we're giving you some of your equity back plus your interest rate. And so if you just do a strict interest rate of I'm getting a 17% return on my money interest rate, well, that's going to change every time you get a little bit of a principal back. And that's why we decided not to do just strictly this is what your annual interest rate is, because that would make more confusion. And so it's the average of over time of your investment. What is that return? And I really feel like I did not simplify that for you at all.
I'm just trying to understand how much will I get back. You said the answer is if I invested 100,000 after 2 years, I will have 131.
Yes, correct. So your return on your investment is just over 31%. So your question is perfect. That's the best way to put it. If you did 100,000 investment, we're projecting that at the end of 2 years you would have $131,000.
And that's pretty good.
And that's the easiest way to simplify it. IRR, there are accountants that can't explain IRR, and I'm not an accountant either.
Is it close to the yearly interest rate, IRR, or no?
Each deal could be quite different.
Yeah.
Although I could have Erica, sounds like she might be a better expert at it than me.
Well,
Do we
It's
ask
been-
ChatGPT after the
Well,
conversation?
I'll give you a great example. Let's say this was a 10-year project.
Right.
And you invest 100,000, but at year 2, you got all of your 100,000 back. But now you're getting a return for year 3 through 10. Well, that's going to shoot your IRR up through the roof because you've got nothing invested from year 3 through 10. And so all of a sudden in that scenario, those two numbers don't even rhyme. Although ours, in the example I gave you, those numbers are close to each other. That's not always going to be true.
Yeah, when you do the longer projects in future, you're planning on doing longer ones where I'm guessing you would want to raise capital before you even start the project, correct?
Yeah. So we've got another one that we'll be launching here soon. It's 105 homes. And that one, we'll sell 20 to 25 a year. And so that'll be a 4 to 5 year project. And so that'll be a much longer horizon.
Right. So theoretically, if I were to invest 100,000 in that project, it would give me a better return, right? Because it's a longer duration.
Not necessarily. It'll just, some people like shorter investments. I don't want to tie my money up for 4 to 5 years. And so the shorter investment meets their needs. So your return isn't going to be much different. It'll be very similar. So at the end of 2 years, in the first scenario, you'd have about $131,000. Well, in the other scenario, at the end of 4 years, you'd have about $165,000.
I see.
And so
It's
your
more or
returns
less
are going
the
to be
same,
similar.
right?
Just one's a longer term, and you just don't have to worry about it for a longer period of time. And the other one, you get your return faster.
Right. And what's the frequency of the payouts?
As soon as there's dividends to pay, so we've got to start selling houses, then we do a quarterly dividend payment.
I see. So if you say you have 25 homes and you sell your first home and nothing else in that quarter, so does that mean all of the proceeds from that sale of one home will be returned?
So not to overcomplicate this, we're also doing an 8% preferred return. And what that means is you get an 8% return before anybody else sees anything. And so that first home sells, we'll have what's called a catch up. So let's say that home sells, it's at month 12, because that's a simple number. So we've now been into it a year. You have an 8%. So if you invested 100,000, at minimum, you have to get $8,000 before anything else goes out the door
I see.
to get that 8% return. So it's a preferred return, saying you're going to get that return before anybody else gets any profit from the deal. And so that'll happen. And so, if we're investing $2 million, well, that means that we're paying out $80,000. Well, one home doesn't make $80,000. So you'll get your percentage of the first. So you might get $4,000. So now we need to close number 2 before we catch up on your preferred return. Then once we catch up on your preferred return, then we're sharing the profits across the board.
I see. So I guess similar to I think we talked to another guest who was explaining like general partners and limited partners, right? So you're talking about preferred returns to the limited partners.
That's
right?
correct. Yeah. So you invest 100,000, you would be what's called a limited partner, and we're the general partner. So the general partner is responsible for managing the business and managing the assets and the returns. The limited partner they're limited to what their investment is. So you invest your $100,000. So your risk is limited to that $100,000, and you're not involved in the managing of the business and the business decisions.
Right. And do the general partners also contribute towards the capital, or they're just responsible for doing the actual work?
It depends on the project. Each sponsor does it a little bit different. In our case, we've already owned the land and we're doing the project, but there might be some sponsors that they're bringing the expertise to the table, and the investors are bringing the equity. And there's others that they say, well, we're putting in half the capital that's needed, but we don't have quite enough, so we're going to raise the other half. So it really can vary from deal to deal.
I see.
Now, you mentioned that your fund you're targeting people like your employees, so not necessarily super high wealth individuals. I'm guessing most of them are not accredited investors, right?
We are limited on people that are accredited investors. So accredited investor, as you talk about, Erica, is it tells you've got to have a certain net worth. You've got to have $1 million in net worth, excluding your house, or you have to be making, I believe it's 200,000 as an individual a year for the last 3 years, or 300 as a couple. That's what qualifies accredited investor. We can have non-accredited investors, but we're limited on how many we can have in the funds. So right now, outside of our employees, we are requiring accredited investors. At some future date, we will be able to create a mechanism for others. There was a bill that Obama passed, I believe it was in 2013, that gave greater flexibility for other people to be able to join these types of investments. And so that's where we eventually are going. So we're not necessarily just targeting super wealthy, as you mentioned. So it's, somebody that wants to invest 100,000 or 500,000, those are really the people that we're targeting. People that they want an opportunity to invest in real estate and they just don't really know where to go. If you've got 50 million, you know where to go in real estate, but it's a little bit harder if you have 100,000, 500,000 type of quantities you want to invest. Now, certainly if somebody wants to invest 2 million, they can, but our target marketing is more of the people that are that 100,000 to 500,000 range.
What is the minimum capital requirement?
On this first one, we're doing 100,000 minimum, which is a great question. You'll see different funds. Some people will go really low, 10,000. Others will, we've seen funds where it's $1 million minimum. You'll see everything in between. There's really no absolute, there's no requirement what it is. It's just more of a function of, if everybody's investing 10,000, you've got a lot of investors. And so that can create its own challenges, but it also creates opportunities. So there's no reason other than we just arbitrarily thought 100,000 probably makes sense based on what we're offering.
Wait, I understand it may create challenges if there are a lot of investors, because some people might want their money back for whatever reason. But what are the opportunities that it creates if you have a high minimum? Or actually, explain when you said it will create opportunities.
Well, it's creating opportunities for those that generally, if somebody's got 100,000, if I'm a dentist, I'm, lots of careers. I'd like to be in real estate and I've got 100,000, 200. Where do I invest it? Where do I go if I want to be in real estate? I don't want to go buy a rental home and have to manage that, but real estate's attractive. And so it creates the opportunity for, people that are in that bracket to be able to invest. One of the reasons also on the 100,000 is, as we analyzed it, is if you've only got 10,000 to invest, it's very unlikely you're an accredited investor. And right now, with us limiting it to accredited investors, that's where the 100,000 made a little bit more sense. Because generally, if you're an accredited investor, you hopefully have more than 10,000 to be able to invest.
Right. No, that makes sense. So here's a question in my head, which, like, when we think about raising capital, although we usually use our own capital, but in a scenario where, say, you have a project, it costs, say, $2 million to complete it, right? We're building a community, and you decide that you're going to raise all of that $2 million, right? So What happens in a scenario where you are only able to raise partial amount? Say you were able to raise 1 million out of that 2 million, right? Because you still have a deadline, right? Because the entitlements don't last forever, right? And then the other investors will also get antsy. So what happens in that situation where you have a clock that's ticking, and you
In,
have to raise the remaining amount of capital.
in our case, we've actually analyzed that. And what we've decided is we have the ability, the next 4 deals, we could fund them on our own. With our goal being to grow, that's part of why we're bringing in the equity partners. So if this first deal we're raising $2 million and we only raise $1 million, we'll put the other $1 million in ourselves and bridge that gap. What that'll do to us longer term is now we don't have that $1 million available to do the next deal down the road, but we have enough to do the next 4 deals. If we raise no capital, we'll end up doing them on our own. And so that's our backup plan. We like to look at everything. What's the best thing that could happen? What's the worst thing that can happen? And if we can't live with the worst, then we probably shouldn't do the deal. And so that's the part of the analysis we did is we can do it without. We would just prefer to bring in partners, and then it gives us opportunity to do more deals down the road.
Right. Oh, that's a good answer.
And how do you plan for market risk? Say another
Recession.
2008,
Yeah,
which
that's a good question. Yeah.
We evaluated, we go through a process when we look at buying a piece of property. We look at it, what's the best case and what's the worst case. And we'll actually, even in the room, sometimes I'll just randomly say, all right, I want you to argue the best case and you're going to argue the worst case. And if everybody in the room can't give a really strong argument on both sides, then we back off. Because if you can't see the downside, then there's something you're missing. Because there's no investment that there's not a potential downside to. And once we understand the up and the downside and we think we've got a good picture, then we make a decision. And part of that is, can we live with the downside? Do we have a plan in place to live with that? The perfect example is when COVID kicked in. I can remember, that March where we just started shutting everything down. And, we had to close our model homes. We couldn't show houses. We could still build because we were considered exempt in construction. But, we didn't have the ability. People weren't comfortable coming into our homes and looking at buying. And people were scared. They didn't know what was going to happen to the economy. So people stopped spending money for a short period. And so I remember we called a meeting and we did Zoom before Zoom was cool. And we had a company meeting, said, okay, this could be a pretty long-term significant deal. If our economy is shut down for 6-8 months while we get through this and people stop buying houses, what do we have to look at? And we do that analysis regularly already of, how much construction work do we have out there? How much capital do we have to pay if all of a sudden every single buyer canceled their contract and we need to pay everybody that we've made promises to? You've delivered lumber, we've promised to pay you. And so if we have to pay all those people, everybody cancels, what is that going to do? And so we do that analysis regularly as a company anyway. And so when this happened, when COVID kicked in, we did all that analysis and we said, okay, are we going to survive? Can we make sure that we can pay payroll? Can we pay everybody? And we said, yeah, we're okay. We can pay everybody. And we need to slow down construction because if we finish every house, then we won't be able to. So we've already planned for this. And so we started slowing construction down and for the risk of we had a lot of cancellations. Now, in this case, it was all a really good fire drill and a good practice because none of the scenarios that we thought potentially could happen happened because actually sales picked up and became stronger. But we go through that exercise pretty regularly. That was just a real life exercise we went through.
Right. So, well, in that example, you as a company, it was all your funds, right? It was not a private equity deal, correct?
We've got that equity partner that I was telling you about that he does invest in quite a few of our deals. And so it was his money, it was my money, and then bank money.
Right.
And so, if we don't pay me, well, I'm the first one that doesn't get paid in those scenarios. Then it's the equity partners. We've got to put their dividends on hold. And then it's the bank. And the bank, you want to be last of not paying them or they'll come take your property. In that case, we didn't. But if we had a scenario that COVID kicked in and we really did have a lot of cancellations, the nice thing about real estate is you still have an asset there. It's not like a business where the business goes out of business and you've just got nothing. You might have some restaurant equipment or whatever your business is. But if the business goes out, you don't have the same assets. So the nice thing about real estate is we still have the asset. And so had COVID kicked in and did what we thought had the potential of being, and that is all of our buyers cancel and we're sitting on this asset, well, then it's just a matter of we need to be patient because we know there's a need for housing in America. People will continue to buy houses. It just may not be today. And that's where you just have to be patient and say, okay, it's not working out the way we hope. We do have a plan in place that we're not going to go bankrupt. We do have a plan in place to pay all of our promises that we've made. Now we just need to be patient on getting the return.
Right. So in a private equity deal, say going back to your example, you have like 28 plus lots that you're developing and you're projecting a 2-year return of like 17% IRR, and like something like COVID happens and you're not able to complete or like sell all the 28 lots or 28 houses within that projected 2 years. So what happens in that scenario? Do you have to explain that to your limited partners and say, well, we can't sell them, so maybe we'll try to rent them and extend the term of the fund to maybe 7 years from 2 years?
Yeah.
Can you walk us through that?
One of the theories that we love is tell bad news fast. So COVID kicked in, we had equity partners in there and we had to slow sales. Yeah, those are hard conversations. You've got to go to the limited partners and say, yeah, the market has slowed down. We're not selling at the pace we planned. Luckily, I have not had any of those kinds of experiences since 2008 of having to deal with that. But that's a real possibility. Could a 2008 similarly happen? It's more likely because of inflation or other factors, but certainly it could happen again. Could a COVID totally shut us down? Absolutely, that could happen. So you have to have those tough conversations, and ultimately you come up with a new plan and you say, okay, this is no longer a 2-year project. It might turn into a 5 or a 7-year project, as you said. And that's where you just share that information, and then you do your best to say, how do we protect this investment? And also, how do we protect that we give you the best returns we can? We're going to have to delay the reward a little bit.
So how do people, and this is something I saw in New York City a lot, people, small scale developers who really want to get into the business, but it's very difficult if you don't have those capital reserves. So what is your advice for someone who's trying to start out?
That's a tough one. It is a capital intensive business. And so somebody that has aspirations and dreams and they want to start out and they want to be involved in the business, it's a lot harder, and it can be done. You've got to believe in yourself. You've got to educate yourself, and you've got to take risk. There's opportunities in all economies. We did really, really well in 2011, 12, and 13. Hardly anybody was building because we saw all these distressed assets, and we worked with banks that owned those assets. So I can remember 2011, there was a bank, they approached us and said, hey, you've had some success with similar asset class that we own a bunch of that we foreclosed on. Could you work with us? And we looked at it and said, well, I'll give you 3 scenarios. I will cash out your asset and I'll give you one price, or I'll give you a little bit higher price and you can work with me on some terms, or you can just provide me all of the capital I need and I'll give you a higher price. In that meeting, they made the decision right on the spot. We will provide you 100% of the capital. So we ended up working with this bank with no money. We didn't put any money into the deal, and we worked with several hundred assets to help work through, and we made a lot of money off of it. And this is in a time when a lot of people were just running scared and sitting at home waiting for the market to turn around. But we saw an opportunity there. And so every market and economy we're working through, there are opportunities. It's just a matter of looking at them and believing that everything is possible. So often we just don't believe in ourselves, or we have misconceptions of what the market is based on, perceived thoughts that we had. But, today there could be opportunities to start small with, rehabbing houses or doing a small development that the seller's willing to finance carry a note, with the land. There's quite a few ways of doing it. It's just a matter of really getting creative and talking and listening to other people that have done it on, what have they done to be creative? Using our example, we worked with the bank. They were in a tough spot. We were able to help solve it. But in turn, they also gave us all the capital we needed to help solve their problem. And so just really talking and hearing of stories, I think, is the greatest way to inspire you to figure out what your story is going to be.
How did you get started initially?
I started the business a long time ago. When I first started, my wife and I got married, and somebody took a chance on me and said, I think you might be pretty good at this banking business. And I got involved in mortgage banking. And I learned a ton from it. And then from there, I evolved into then working for a home builder. And I've always been an entrepreneur. Back when I was 7 years old, I came up with this plan on raising pigs. And I was clever enough to say, a lot of people like pork. And who can resist a cute little 7-year-old that shows up at your door? And I show up at your door and I say, hey, do you like pork? Yeah, we do. I said, well, how would you like to just have a little bit always in your freezer year round? And you know that it was raised humanely and it tastes delicious. Like, yeah. I said, okay, well, I'm going to raise a pig for you. And you give me 50% of the money right now. And then in 6 months, I'm going to deliver you your pig because it only takes 6 months to grow it. So 7 years old, I went to the local bookstore and I bought this book, How to Raise Pigs. And 7 years old, I read this book. So I go to your door, you give me the money. Well, that's enough money to actually buy the pig and enough feed to raise it in 6 months. And so then in 6 months, I would ask for your other half, and that would cover the processing plus my profits, and I would deliver your pork. So that was my first entrepreneurial venture. And so after I had worked for this home builder, I ended up getting into a Radio Shack franchises that I bought a Radio Shack franchise, and we ended up having 3. That was a lot of fun. In the year 2000, one of our stores was the biggest franchise in the world. And that was a lot of fun, but retail wasn't my thing. We talked about earlier, I just love creating communities and something that's meaningful. And as we all know, Radio Shack just really has no value because it doesn't even exist anymore. So I didn't feel like I was giving much back to the society. So we sold those. And then I went to work for a company that had started their own city basically in Utah. So they created their own sewage company, their own water company. We developed a golf course, the retail centers, apartment buildings. Today the city's probably, I don't know if I had to guess, 30 or 40,000. I'm not even sure. People live there. And so we developed this city. This is in the early 2000s. I did that. That was a lot of fun. Started my own home building company with a partner that had put the money in. And we did that for a few years. It went well, and he wanted out because he was retirement age. So we sold that to another home builder. Then I went to work for a national home builder, and that's where I was with them for 6 months. They asked me to move to Minnesota, and so we moved here. And then in 2011, I just saw an opportunity and the itch to be working for myself and started up Centra Companies at that point. And then that's what we were working through a lot of bank assets. In 2013, 14, we started developing our own land because we'd worked through, I could buy lots at that time that, today would sell for $80,000. We were buying them for $5,000 back in 2011, and we would build on those. But once those all were worked through, that's when we had to start developing again ourselves.
So the question I have here is, it also, so when you first started out, you had a ton of experience already. So imagine that's how you were able to access bank financing and get the opportunities you had with the banks. So for someone who's just starting out, my impression is you either need a lot of experience, right, to be the person who people trust to do the project, or you need money.
You work for an existing company until you have experience, right?
Yeah, that's.
I think there's a few things involved here because you're right with all of that. It could just feel so daunting. Geez, look at what he has. How did you get to that point? How do I start? I'm a believer, the principle that you hear that we're the average of our peer group. And I think that's true. And so people that are aspiring, they want to become something, I'll often say, I want you to envision, where are you going to be 10 or 20 years from now? What does your life look like? That could be relationships, financially, business, whatever what does that look like? And after people think about it for a minute, I say, well, how many people do you associate with on a regular basis, not periodically, but on a regular basis that lives that life? And if anybody ever says 1 or 2 or 3, I say, Well, your dreams aren't very big then. Most people are going to say, I don't have anybody, because if I'm 30 years old, well, most of my friends are probably around that same age and they all have big dreams. So what do I do? How do I become the average? So I'm a huge believer in education. I read 50 to 60 books a year. And that's in part is I just love to learn. But by reading, that can create your peer group. That can create the possibilities. That can create the planting the seed of hearing of somebody's experience of, I worked with banks and used their money when we first started getting going and it didn't cost me any. That's where you hear stories of a friend of mine, Keith Cunningham. He wrote a book, The Road Less Stupid, brilliant business book. He talks about when he first started out of buying houses that he would fix up and get a loan on them. And then he'd get a loan, he'd fix it up and it'd be worth more money. And then he would go refinance it and he'd get some cash out and buy the next one. Ultimately Keith's worth several $100 million, but he started out buying a house one at a time. And that's how he started building experience. But by reading books, by listening to podcasts like this is a podcast, you guys have had several guests that have had really good success in their life. And so you go to these podcasts, you listen to your podcast on a regular basis, you're hearing about other people's successes, and your success might not be the same as a guest that you had, but that success of the guest you had plants a seed in my head and helps me envision what could be. What are the possibilities? How do I build that credibility? How do I get started? And I can think of several podcasts that you guys have done of guests that have done some really incredible things that have made me pause and think, that's pretty cool. How does that apply in my life?
Yeah,
Well, I'm glad that the episodes were helpful. that's
No, I'm sure.
I love your podcast. It's a lot of fun. I watched one and I'm like, I don't know if I'm going to be any good guest. I'm not nearly as funny as most of your guests.
No, I think you made it up with the amount of education you're providing in terms of like private equity and how deal flow works and your own experience. So I think we appreciate you for that. I still have like a couple of questions regarding the private equity fund. I know we're running over time. How do you market? Like how do you get those? What is it called? Accredited investors? Yeah. Like what's a good strategy for marketing just to that specific pool?
So there's a lot of different strategies that we're using. LinkedIn is a great resource. We're using a lot of different ads. There's something we're all familiar with, whether we know the term or not, is retargeting. So we've all seen that, I type in, I want to buy cowboy boots. And next thing I know, everywhere I go online, somebody's selling me cowboy boots. And it's like, how in the world are they reading my mind? And so there's so many different ways that we operate that they can discover what it is we're interested in at any given time. I buy my cowboy boots and it's like, enough already. Don't you guys know I bought my cowboy boots? That they don't know because I keep getting the ads. And so we'll do that. So we have the ability to see online people that are interested in investments, people that are wanting to be in real estate. And so we can do retargeting through, LinkedIn, YouTube, Facebook, Instagram, Google ads, all of those different mechanisms. You can really zoom in. And so if you're trying to sell a product, go find somebody that's an expert at finding that demographic. So we brought in an expert that knows how to find them and we'll do targeted ads. We're doing, we've got a webinar that we're going to do that talks about the investment itself. And so we've got our website, centracapitalpartners.com. We're pushing it through there and pushing it through LinkedIn. So we'll do a webinar that talks about the investment and that people can ask questions at the end and share. And so there's a lot of different things that we're experimenting with to see. And I think a lot of things in business, if you just try one thing, and it doesn't work, how much time did you lose? But if you try 5 things all at the same time, you're much likely to get where you want faster. And I think that's true, whether we're marketing a private equity offering or I'm starting up a home building company or land development or, retail, whatever it may be.
Right. I'm curious to know the webinar. Is that a live webinar or a pre-recorded one?
So we're going to be doing both. We do have a live webinar that we're doing on March 19th that people can sign up. I think right now we've got 80 people signed up to watch it. And that one will be live. And so I will share about different real estate investment theses and then talk about specifically this one. And then it'll open up to question and answers from the people in there. We also are doing one where I'll explain the offering and show different slides that depict what we're doing. And that one will be pre-recorded. And then so that one will be more of an on-demand because not everybody is available on the 19th of March to be able to watch the one that's live. And so we'll have one that's also pre-recorded. So somebody that says, hey, I just want to watch it on my time and they can see the same thing. The disadvantage is now they don't have the ability to hear questions and answers.
Right. So it is a new territory for you as well, right? Since so far you have been securing funding through your funding partner and through banks, correct?
Correct. Raising capital from the general public is brand new. Raising capital from a single partner is not new, and developing is not new. But going to the public and saying, "Would you like to invest $100,000 in this opportunity?" That is a new opportunity for us.
Right.
And how much of your time now are you spending on marketing to investors versus the other aspects of the project?
For me, I'm investing quite a bit of time in the equity raise just because it's new. Being a new company and a new adventure, I'm spending quite a bit of time. So probably half of my time is focused on the equity raise. Not all just marketing of it, but the structure, the legalities, all of the different components that go in starting a new business. It's probably about 50% is invested in this right now. We've got some really talented people that are running it. So in time, I will be not as engaged in that and more focused on new real estate opportunities.
And how big is your team?
On the equity team right now, we've got 3 full-time people that are doing that, and then about a dozen different consultants that are experts at certain aspects. So we've got a team that's expert on using LinkedIn that helps us succeed there, but they're not an employee. So we've got a lot of different consultants that we use, and then the three-time full-time staff.
And what about on your construction and the development side? How big is the team there?
Oh, I think right now we're right around, I'm going to say 20 people on the construction side. Now, be mindful, we don't do any of the work. So we're finding contractors, we're coordinating, we're supervising, getting the work done, but we don't physically do any of the work because indirectly we employ probably 800 people that are on our job sites on a regular basis. But directly, the management of it, the administration of it, the accounting, those kinds of things, we're right at about 20.
Right. So it's mostly like project management for you at this point, right?
Exactly.
But do you actually go to like the physical locations to like monitor, or is that?
Yeah, I was on 2 job sites just yesterday morning, looking at them, making sure everything was going well. We have project managers that are on them every day that are inspecting the homes, making sure that they're being built correctly, make sure that people are there on time, that they're putting in the right finishes. Myself, I'm not on the job sites every day, but I try to get on all of our jobs fairly regularly just to touch base with our team and make sure things are going well.
You are the GC of record, though, on the project?
That is correct. Yep.
Yeah, okay.
Cool.
Yeah.
And I think the last question I had was, and this I'm only asking because if I don't ask on behalf of Erica, and because she's representing the land investors, they'll get mad. So if any land investor is listening to this, right, and they, do a lot of land deals, is there any opportunity for them to partner with you in terms of they secure a deal and then they sell it to you and you develop them?
Yeah, we'd be interested. We just hired the president of our company is actually my brother, David Wills. He just joined our team about 6 months ago, and that was a strategic hire. He has experience in building. Any given time, he would be managing over $1 billion in construction projects all over North, Central, South America, and Africa. And so we brought him onto the team because we're now looking at where can we expand opportunities, whether it's homes that are built for rent, apartments, a hotel, anything real estate related. We're really looking at the entire footprint of the United States. And so we are always looking for good partners, whether it's, they've got an opportunity that we could help develop, or it's somebody that's wanting to invest money in a deal. We think it's all about building great relationships and, bringing in people that've got great talent. So we're always looking for those opportunities.
And I'm guessing you have like specific criteria, like how big, like you're not going to deal with anything less than 10 acres or something like that?
Acreage size is tough because, you can, depending on where you're at, Manhattan's a great example. You can give me a quarter acre and I can put hundreds of units on it. So a quarter acre might be fine. You give me a quarter acre in the area I live. I don't know, you can see here, I actually have a cattle ranch I live on. Give me a quarter acre here and I can't even put one cow on it. So it really does depend. If I'm doing a traditional city lot, probably want to have at least 10 acres. If I'm doing an apartment complex, depending on where it is, the density could be anywhere from 30 units an acre to 100 units plus an acre. Actually, you can get way above 100 units an acre. You get in density. So it really depends on the location. A hotel, you just need a couple of acres. So it depends on what the application is on the size. But there is a point where, if we're building single family lots and we can get 3 houses to the acre, a 2 acre piece probably doesn't make sense to make work. So it really is, I'm not answering your question very good because the answer is it really depends on the piece and the location.
And on the land investing side, I also have to ask.
Well, now she's asking because I
this
blew up your spot.
Has it ever been the case where someone who is a specialist just in acquiring land but has never done development, have they ever come to you and said, I'll bring you this property and I want to learn more about development, so I'd like to come in as one of the partners in exchange for providing the land? So that
we have had a lot of people approach us and we've never taken them up on that. Mm-hmm. With our new business strategy, we would love to do that with people. As we pivoted as a company. So if somebody comes in and says, hey, I don't have the expertise to do the entitlements, to do the development and all of that, but I found this good opportunity. Can I take the equity I would make by selling it and keep it into the deal? Yeah, we would treat that the same as if you were, if you had 500,000 in equity in the deal, that if I bought it, you'd put 500,000. Absolutely. Yeah. You can keep that 500 in the deal as your investment, and then you can get the 17.8% return or whatever it might be on that deal. So that is something we very much want to be able to do, because then it gets the opportunity for, somebody like yourself that says, hey, I found this really good deal in Nashville, but I don't have the expertise to do it. Can we stay in this partnership long-term? And say, yeah, absolutely. We love partnerships.
What about in the same example, they don't really want a partnership and they just want to assign, quote unquote, assign you the deal so they get their assignment fees? Is that something you'll entertain?
We do that. Yeah, we've bought deals where they assign the purchase agreement as an example, and we pay them a sum of money to buy that purchase agreement. So now we basically bought the rights to buy it. So we've done that several times in the history of the company.
Okay. Actually, yeah, I know. I said that was the last question, but this is like the final last question. Feasibility study. I mean, we have looked at it a couple of times when we buy land. A lot of times, developers will request a feasibility study be done on it before they even get approached. So, how do you find someone or find an expert that you can trust to perform feasibility study on a vacant land?
So we do that internally. We don't trust anybody but ourselves to do feasibility studies. Somebody that maybe doesn't have the history and the experience. Engineers, for some of it, are really good resources. Engineers that they understand that market. They understand different soil issues, historical issues. But it's really through consultants if you don't have that internal. Now I'll use an example. We may not do the soil study, but we have the experience to know we probably need to do soil borings and find out what the soil is and is it going to have proper compaction. And so then we'll hire somebody that does the soil, and then we'll analyze what their results are and say, does this still work or not? And so you're always relying on consultants at some level. The feasibility study does this work. You can hire companies that will do the feasibility part of, well, what product will sell? What is the demand? Is there a need for this? If you're building apartments, is there a need for this class type of apartment in this location? Is there, what rents could you get? And so there's consulting groups that'll do that part of it. And then other consulting groups that'll do the feasibility of, can I even build on this ground or not? And so it's really through a lot of different consultants that you have to lean on. And then I would caution anybody that's doing that, review those reports really closely. I can remember we brought a deal on an apartment complex, and they brought me this feasibility study. And so I go right to the executive summary and I skim through it. And the last paragraph is, this is a great deal. You should do it. And it gave all the reasons why. Well, okay, this is worth it. I set it aside to be able to read the entire study. I read through the entire study. I'm reading through it and going, I have no idea how they came up with the conclusion this is a good deal. Because, it talked about, this apartment, they're going to charge $1,500 a month in rent, but the average rent's $800. And they talked about vacancy rates were 8 and 9%. And I'm going through all this going, this market's not a disaster, but certainly it doesn't make sense to build a brand new apartment complex. And so I came up with my own conclusion based on their research, but I did not agree with their conclusion. So you have to be really careful to make sure that you're understanding the background, because that's where sometimes people get stung, is they do it just based on those feasibility studies of these consultants. And then they get into it and find that maybe the consultant didn't understand it as well as they thought they should.
Yeah. It's the same thing with title reports. You
Yes.
remember, Erica?
Yeah.
Where this there was actually undivided interest in the property. So there were like two owners with 50% interest. And essentially, the title company didn't flag it because they're like, well, we don't care that there's a 50% interest. And like the buyer was not even aware what undivided interest means. So they ended up buying the property, and then later they can't sell it because they only own 50% of it. So
yeah, that's a perfect example. We get a title report as part of our feasibility study on every project, but we don't just read the first page of what the title company says. We actually go in and look and read the report, what's on that property. And that's where it's really important that you've got consultants that you really trust and they know what they're doing. And then at some level that you're learning yourself and understanding what the risks are, because real estate is not for the faint of heart. It's there's a lot of pitfalls, as you just described.
Right. A lot of attention to detail.
Yeah.
I would be curious to know, Erica, you want to send a copy of your book that you wrote on land due diligence
Sure.
to Dale and get his thoughts on what he thinks?
I would love to read it. I love learning new things. I would love to read it.
Yeah, let me know if there's anything I missed.
Oh,
It's due for another update.
Yeah, she basically so when she started land investing, just a brief history, she basically wanted to be thorough with her due diligence checks, and there was like no resource out there which will tell you every possible due diligence item that you should be looking for. So she started researching, and she eventually took like a year or so to write that book where she came up with like every possible due diligence item, and we put it in a book, and we put in some stories as well to make it interesting.
I love that, Erica. That is awesome. Anybody that has a discipline to write a book is a rock star in my view. And, the reality is every year of new experiences you have, you'll be able to write a new chapter to your book. But,
Right.
You've written a book that, chronicles a lot of the experiences you've had, which are real and can help people that are starting out to say, oh, here's some things to be aware of. And so I think that's awesome.
Yeah.
It was fun.
Yeah, it's an
Yeah.
interesting story of selling a $9,000 property or buying a $9,000 property from a billionaire. So
Oh,
there's an interesting story, interesting chapter in that.
Yeah.
If for anyone who's listening, why
yeah.
they have to
I'm
buy
gonna have to read it. Those are always the funnest stories.
it.
Yeah,
Anyways,
What's the
send you
name
a
of your
copy.
book, Erica?
land investing mistakes.
Land Investing Mistakes. Perfect. I'm gonna get my
Yeah.
hands on it.
Well, we'll send you a copy.
Yeah, we'll send you a
Yeah,
copy. Anyways, this
Um,
was great, Erica. You should.
Yeah,
wanna
well, we've
close us
gone
out?
way over time, and we could probably still keep going, but we don't want to keep you too much longer. So
I think
Yeah,
it
we
was a
can-
lot of fun, and
Yeah.
this is a fun conversation. Real estate, we could talk for days. So you got to
Yeah.
end it somewhere.
Right.
yeah, you have such a wealth of knowledge. Like I said, I could keep asking questions for a long time, but we will let you get on to your next task. And for anyone who wants to invest in your fund or wants to learn more, how can they reach out to you?
Our website would be the best, Centra Capital Partners, and it's a Centra with a C, CENTRA, CentraCapitalPartners.com, and yeah, lots of fun, good information there.
All right. Thank you so much for your time. We appreciate it.
Thanks for having me. Appreciate you both.